risks faced by the participants in derivatives. We're going to dive into the various risks people encounter when they step into the world of derivatives. It is really important for us to grasp how these derivatives, which we call as leveraged instruments, actually function before we start using them. By the end of this video, you'll have a much clearer picture of what to watch out for as a market participant. As we move forward, we can break down the risks into 5 distinct categories: counterparty risk, price risk, liquidity risk, legal and regulatory risk, operational risk. We'll be looking at things like the reliability of the person you're trading with, how prices move, how easy it is to exit a deal, the legal rules of the game, and the systems running behind the scenes. Each of these plays a crucial role in your trading journey, and we're going to explore them one by one. First up is what we call counterparty risk. In simple terms, this is the danger that the person or institution on the other side of your deal won't be able to keep their promise. If they fail to meet their end of the agreement, it's known as a default. Essentially, you are at risk if the other party doesn't fulfill their contractual obligations to you. Next, let's talk about price risk, which is probably the one most people think of first. This is the chance that the value of the asset you are interested in moves in a way you didn't expect. Basically, if the price goes in an unfavorable direction, your position will lose money. This financial loss happens simply because the market didn't go the way you hoped it would. Now, imagine you are in a room and suddenly need to leave, but the door is locked. That is what liquidity risk feels like in trading. It's the struggle to get out of a position when you want to. This happens when there aren't enough buyers available in the market. Without someone to buy from you, you can't sell quickly enough to stop a loss, effectively trapping you in that trade. Then we have legal or regulatory risk. This is the possibility that a contract you have signed can't actually be enforced by law, or perhaps the government changes the rules of the game while you're still playing. These shifts in regulations or issues with the fine print can have a real negative impact on how your trades turn out. Another area to watch is operational risk. You can think of this as the gears of the trade breaking down due to mistakes inside a company's internal processes. This might involve things like simple human error, paperwork that isn't filled out correctly, or even dishonest behavior like fraud. It's all about the risk of something going wrong with how the trade is actually handled and executed. Is this right for you? So you might be wondering, is derivative trading right for everyone? Honestly, it might not be the best fit if you have limited money to work with, if you're still very new to trading, or if you prefer to avoid big risks. It is vital to look at your own situation and decide if this high-stakes environment truly matches your personal comfort level and financial resources. To help you understand these dangers, there is a very important book you'll receive called the Model Risk Disclosure Document. This is provided by exchange members, right, when you are signing your initial agreement. It's packed with essential details about how trading works in both regular stocks and the more complex futures and options markets. Finally, before you make your first move in the market, you really need to treat this document as required reading. Whether you are looking at the standard cash market or the futures and options segment, your broker will give you this guide. Make sure you take the time to read it carefully so you aren't caught off guard by the risks we have discussed now.